CindyBrooklyn.com, and we are back at it with student loan forgiveness with Carl Dimailig. I love having Carl on the show because I don't like paying more than my fair share for things. I'm not a fan of student loans, and I've made that very, very clear in the past. And Carl and I are in complete agreement that these loans are straight from the devil. They compound daily. They are keeping people enslaved in debt. And we want to talk about what we can do to help you get out of your student loan. And Carl's got the answers, and this stuff is real. So we're going to talk a little more today about all the income-driven repayment plans. Is that right? So, Carl, I'm going to just kind of turn this over to you. We were talking a little bit about taxes earlier, and you get to pay taxes on the forgiveness of debt, but we're going to cover first and foremost what it looks like to get these student loans, get them lowered or forgiven.
Great. So let me first talk about what I'm not going to talk about. I'm talking about what I'm not going to talk about.
Got it.
The old way of thinking about student loans was just like every other loan out there, where it amortizes and you pay it off in full. Of course, the traditional way of thinking was the faster I pay it off, the cheaper it is because there's less interest.
Correct.
That was true until income-driven plans were created in, I think, 1993, became active in 1994. So now, instead of paying off the loan at either 10 years for as long as 30, there's an ability to have your monthly payment based not on how much you borrowed, but on your adjusted gross income. So that's a blessing and a curse. Mm-hmm. It's a blessing because if you are just starting your career, you're not in your peak earning years yet.
That's right.
So they'll adjust down your monthly payment. Now, this applies for every income-driven repayment plan out there. There's 5, but there's only 2 really good ones that we've covered already. Pay-as-you-earn and revised pay-as-you-earn. So if it benefits you a little bit, I'd say do it because comfort. You want to have enough money monthly for living expenses.
Yes, yeah.
So let's just round number. Let's say you borrow $250,000 to get your super degree, whatever it is.
Right, which is not all that abnormal.
Right. So
unfortunately,
traditionally in the 10-year plan, you'd be paying about 1% a month, so $2,500 a month. But let's say because of your income, it's kind of good that you were able to lower your payment instead of $2,500 a month to $2,000 a month. Well, that's nice. You have a little bit more breathing room, and there is a good chance that you might pay this loan off in 13 years, 15 years, 17 years. It'll be a little bit more expensive, obviously, than paying it off in 10 years, but at least you were living a little more comfortably those 13 years. Now, if you did a really good job in lowering your monthly payment, and I don't mean by earning less money, I mean by taking advantage of everything called an above-the-line deduction, 403Bs, HSAs. Let's say you lowered your payment down to $500 a month. That's really cool, but $500 a month on a $250,000 loan,
not good.
You're not going to pay that off in 20 years.
That's right.
So the blessing is that you're only paying $500 a month. The curse is that 20 years down the road, your loan, or 25, depends on which plan you pick, whatever balance you have left, it could be $100,000, it could be $150,000, it's forgiven as a debt. It's now taxable as income on that year. So let's say it's the year 2040. You're making $250,000 a year now, and you're used to paying taxes on your $250,000, but you just got $100,000 forgiven. Or you got to pay taxes on $350,000.
Yeah.
And if you were not preparing for this for those 20 years, that's going to hurt.
Yep.
But I want to go back to what I said 2 minutes ago. If we lower your payment from $2,500 to $500, Cindy here has some programs that will make you smart with your money, because if we know you have 20 years to prepare for $100,000, you have great programs for that.
Yep. And we've just put $2,000 away for you versus $2,000 away for your government loan. Now we're putting $2,000 a month away in a compounding account. So this interest is making interest. This interest isn't sitting in your bank account doing nothing. This interest isn't writing for free. This interest is now making interest on interest. And now, if it does come time and you've got to pay a big tax, that extra tax, whatever that's going to look like on, $100,000, again, you got to add that into your ordinary income as well. Now you've been prepared for it. But that money, that extra $2,000 a month, is coming into your accounts versus the government's accounts. Okay, sorry, I digress.
No, that's absolutely important, because if someone comes to me for help and I can do this, that example, $2,500 down to 5.
Yeah.
If they do not prepare for their income tax in 20 years, I don't take them as a client, because
That's right.
they'll just turn around and blame me.
Well, and here's what I tell people when I've done the student loans. It's the same thing. Is you're better off to just not pay your student loan than to not pay taxes. They're not going to come after you on that level for not paying your student loan like they will if you don't pay your taxes. You get in trouble with taxes, the trouble is, it's outrageous. So I tell people, look, you're better off to just stay where you're at if you don't prepare for the tax bill that you're going to have on this later. Because here's the thing, the government is basically giving you a 30% discount on your student loan. But they're going to get paid regardless. Either pay us in interest on the student loan or pay us in taxes. They want their money. Either way, you're going to pay. You jumped in bed with the devil when you got the student loan. It is inevitable that you got to pay them back. So we tell the students, pay your taxes.
Okay.
But this is the great thing. The great news is when you get with Carl and I, we're going to walk you through step by step. So it's going to be easy for you to do this. Super easy. Trust me.
And it's also mathematically possible that if we lowered your payment by $2,000 a month, in 20 years, you could still actually, with the tax on the forgiven debt on $100,000, let's just say it's $35,000. That could actually be cheaper than you having paid off a full $250,000 in interest.
Without a doubt, it's always cheaper. Every time I've done the math, it's always cheaper. So, like I said, it's a 30% discount. Like, if you know your favorite store has having a 30% discount, will you go? Will you take advantage of it? So this is about preparing for that and knowing you're going to get a 30%, discount.
Here's the scary thing. The Tax Cut and Jobs Act sunsets in 2025. And what that means is after that, so until then, forgiving student loan debt isn't taxable. Very short period of time. What that means is January 1st, 2026, let's say you don't have student loans, your spouse does. Your spouse passes away. The debt now gets added to income to your community property estate, and the spouse is going to have to pay taxes on that. So be prepared for that too.
Isn't that crazy? Student loan debt is just the gift that keeps on giving, isn't it? Like, people don't realize. I tell people, when you're meeting someone and you're dating and you find out they have a student loan, you get that debt when they become your spouse. It becomes part of yours. And your children do as well. Tell us about that.
So it's basically, that's going to affect your household lifestyle.
Very much.
Technically, the debt is in the name of the borrower, but if you're sharing income in the same household, it affects everyone in the household.
That's right.
And yes, the ideal is you got loans to improve the future earning potential, but that's not the case. I've seen people with master's degrees,
right,
being a barista.
Yeah, most master's degrees. If I see clients all the time on the mortgage side, on the financial services side, on the student loan side. And most of the clients that I see with a master's degree, it doesn't help them in any form or fashion, and it's not, all they have is more debt and less income. And I implore you, if you have a student that's going to be going to college, really take a look at benefit, pro versus con on going to school versus not. And starting maybe in community college versus going to a state school right away, or an Ivy League school. If you're not getting student loan grants, or grants or a free ride, most of the time now, you're not going to out-earn someone that doesn't have a student loan or someone that hasn't gone to school. And I am not I'm not anti-college, I'm anti-college debt. And this is the problem if you haven't prepared for the amount of cost of school, because I'm the inflation that has ridden with student, college, kids aren't getting their fair share now, and we need to really look at that. We need to use common sense and do the math when it comes to school. And that's where someone like me can come along and go, let's just pencil the numbers. Because I've taught my kids since they were little, pencil the numbers and let's make sure this makes sense. Nowadays, college doesn't necessarily make sense unless you're going to go be like a brain surgeon. Would you agree?
Yeah. Very few things, again, if you need a license to do it, there are professions that don't even require a degree.
That's right.
Insurance
Like even
licenses.
stockbrokers, the business I'm in, if you can pass those exams, which are not easy to pass, but if you can study and pass those exams, you don't need a college education to be in mortgage, to be a stockbroker, to be a financial planner. There's so many jobs out there, electricians, plumbers. You don't need a college education to do, but yet it's almost guaranteed to make 6 figures a year. So why would you go to school and spend $100,000 to make 6 figures a year when you can do it without school? Agreed?
Yeah, definitely. It's, again, like you said, always look at the numbers. Mm-hmm. Look at your life in 10, 20 years. Of course, when you're 18,
it's hard to do.
You're thinking about turning 21. That's
right.
about it. But yeah, there is one saving grace, though, that we'll get into next episode. Absolutely.
What are we going to talk about?
That is the coveted public service loan forgiveness portion, which is in addition to the income-driven repayment plans. And what that means is, instead of having your loan forgiven in 20 to 25 years, as with the income-driven repayment plans, and having tax on your forgiven balance, public service loan forgiveness, you're only paying into your debt for 10 years. So half the time, okay, saves you a little bit of money, but after 10 years, there's no tax on the forgiven debt, which could save you 6 figures.
Absolutely. So we get into that next episode. But right now, guys, if this conversation interests you, get a hold of us at cindyberkland.com and let's have a conversation.